In today's video, I'll tell you everything you need to know about mortgage interest rates and the 3 big questions you need to ask yourself when looking for a mortgage deal. Hi, my name is Jeena. Welcome to my channel. On my channel, I share lots of tips and tricks for saving time and saving money. What is an interest rate? Interest rate is the cost of borrowing or the profit made by the company that lends us the money. The mortgage interest rate has been the lowest it's been for many years in England. But because you're borrowing a large sum of money for buying a house, the mortgage interest can quickly add up. So why does the interest rate go up and down? The main reason for this is the economy. So if there is a lot of growth and inflation in a country, then the mortgage interest rates are quite high. And this is to discourage spending. Whereas if the economy is at a low, like it currently is, if it's gone through a deflation period, then the interest rates are low. That is to encourage people to spend and to boost the economy. There are 3 big questions you need to ask yourself when it comes to mortgage interest. First is repayment versus interest only. With the repayment mortgage, you repay some of the capital you've borrowed from the bank plus the interest. With an interest-only mortgage, you pay only the interest, and then at the end of the mortgage term, you need to find a lump sum of cash to pay the bank for the outstanding mortgage balance. So let's look at the pros and cons of repayment versus interest-only mortgage. With an interest-only mortgage, you have very little choice. Especially as a first-time buyer, you literally have no choice. Most banks and building society want you to pay the capital as well as the interest because they do understand that most of us will struggle to find a lump sum of cash to repay the bank at the end of the mortgage term. The repayment mortgage tends to be more expensive than the interest-only mortgage because you're paying some of the capital as well as the interest, whereas with the interest-only, it's only the interest, so repayment mortgages are more expensive. But because you're repaying the capital as well as the interest, the loan to value or the proportion of the house you own, for example, with an 85% loan to value, 85% is owned by the bank, 15% is owned by you. But if you continue repaying the capital, it'll soon be 80-20. So you own 20% of the house and the bank owns 80% of the house. So as you continue paying the repayment mortgage, your loan to value will reduce, so your interest rates are better with a lower loan to value. There is a very strange effect with mortgage interest, and this chart shows it beautifully. In the early years of your mortgage, the outstanding loan is quite high. So your monthly repayments goes towards more of the interest and less of the capital. But as you gradually repay and you gradually reduce the amount you owe, most of your repayment goes towards the debt and less on the interest rate. Second big question you need to ask yourself is whether you want to go for a fixed rate mortgage or a variable rate mortgage. So this is a bit more complicated area, and let's look at both of this in a little bit more detail. With a fixed rate mortgage, usually banks or building societies give new customer an offer of 2 years fixed rate or 4 years fixed rate or 5 years fixed rate. Actually not 4. It's usually 2, 3, 5 or 10 years fixed rate mortgages. This is just a new customer bonus to get you to be their customer. So fixed rate mortgages, the interest rate is slightly higher than a variable rate mortgage. And because it's fixed for the 2 years or the 3 years or the 5 years, the amount you repay the bank will be the same amount month on month till the term of the fixed deal. The big advantage is you will know exactly what you're paying, and depending on whether interest rates go up or down, it does not matter. You will be paying that fixed amount for the term of your fixed rate mortgage. But the downside is you're fixed for that term, so you cannot sell the property or repay that property. There is big exit penalties that you need to pay if you do not complete that contract. On the other hand, variable rate tracks the Bank of England base rate. Like I told you previously, depending on whether the economy is doing well or the economy is doing poor, the Bank of England sets a base rate. So the variable interest rate tracks this Bank of England base rate. And to confuse you even more, there is 4 different types of variable interest rate mortgages. First is tracker mortgages. Tracker mortgages are also a new customer bonus, and the offer period lasts usually 2 years or 3 years or whatever you agree with the bank. It usually tracks the Bank of England rate plus an additional 1 or 2% above the Bank of England rate. So currently the Bank of England base rate is very low at 0.1%. So a tracker mortgage will be usually 1% or 2% above this Bank of England base rate. If and when the economy does better, the Bank of England will increase its base rate. The tracker mortgage will increase by 1 or 2% above the base rate. Second variable rate mortgage is a standard variable rate. The standard variable rate differs from bank or building society, and they can choose whatever they want their standard variable rate to be. Standard variable rate is the rate we all go to when we finish our fixed term deal or the tracker rate deal. We go on to the standard variable rate, which is usually quite high. So when you know you're coming to a standard variable rate about 2 to 3 months before you come to the standard variable rate, you should start shopping around for other mortgage offers. The next rate is a discounted rate. Discounted rate is individual from bank to bank, and it's a discount of the standard variable rate. The big downside for this discounted rate is if the banks increase their standard variable rate, the discounted rate increases as well. And so it's just a discount of the standard variable rate. The fourth variable rate mortgage is a cap deal. With a cap deal, if the interest rate drops, you get the benefit of the interest rate drop. But if the interest rate rises, it is capped at a certain level, so you do not ever pay over that capped level. Although usually the cap is set higher than a fixed rate deal. So what do you choose, a fixed rate mortgage or variable rate mortgage? Nobody really knows what the economy would be doing. The economy is usually calculated from the previous 2 quarters. So you can always look in hindsight. You cannot look in foresight. So nobody really knows in foresight what the market or the economy will be doing. So you decide what you want to do, whether you want to fix and have the peace of mind with a fix, or you want to take a little bit of a risk where you want to pay the lower interest rate when it is low, and you can afford a little bit of spare cash if the interest rates go up. So there is no right or wrong. Do what you think is right for you. The third important thing that you need to decide is whether you want any flexibility with your mortgage. So the main thing about flexibility is whether you want to increase or decrease your repayments. You probably don't want to decrease your mortgage because you want to eventually pay off your mortgage. So the question arises whether you can overpay your mortgage to quickly finish your mortgage debt. Most mortgage companies are very strict on how much you can overpay on your debt. And usually the cap is about 10% of the amount you owe the bank. So for example, if your outstanding mortgage amount is 100,000, you can overpay that year by 10,000 pounds. There's usually a very heavy penalty to pay if you overpay by more than this fixed annual amount. Most people do is they collect an amount in a savings bank account, and when you come to the end of your promotion period of your fixed or your variable rate, and before you go on to the standard variable rate, then they look at remortgaging and overpay by this amount. For example, if you've saved 5,000 pounds in your savings account and then you come to remortgage, you overpay the mortgage balance by this 5,000 pounds and the loan to value further decreases. There is another option called offsetting. My mortgage company allows for an offsetting bank account, and it depends on bank to bank. So with an offsetting bank account, say you had a 5,000 pounds in this offset bank account and the mortgage amount is 100,000 pounds. The interest is charged only on the 95,000 pounds. Because there is 5,000 pounds sat in your offset bank account, the mortgage interest is offset for this 5,000 pounds. So it's best of both worlds. You get the reduced interest rate and you can access the money whenever you want to. So it's best of both worlds. I hope this video has given you a clear understanding of mortgage interest. If you have any questions, please drop it in the description box below. So like, share and subscribe, and you know the drill. Before you go, you may want to check out these other videos on home buying tips. Thank you for watching me today and stay safe. Bye-bye.